Let's just jump right in. If you've ever felt totally overwhelmed by financial jargon, or you're just not sure what to actually do with those first few real paychecks of your career, you are absolutely in the right place. In today's explainer, we're cutting through all the noise. We've distilled hard institutional data from absolute heavyweights like Vanguard, Wells Fargo, and JP Morgan into a highly actionable wealth-building playbook. The goal here? To set up your financial future on autopilot so you can actually enjoy your life today. Spending your hard-earned money on amazing experiences rather than just accumulating a bunch of material things. So here's our roadmap for today. 1. Time is your friend. 2. Maximize the free money. 3. The power of autopilot. 4. Embrace low-cost indexing. And 5. Discipline over impulse. Let's get to it. Section 1. Time is your friend. There's this incredibly powerful quote from Vanguard's late founder, John C. Bogle. He said, "Time is your friend, impulse is your enemy." This idea is actually highlighted right front and center in the Wells Fargo 2026 Mid-Year Outlook Report. And honestly, it's the ultimate anchor for everything we're going to talk about today. When you're just starting out in your career, time is literally your greatest asset. Compounding, which is basically your money making its own money, needs decades to work its real magic. And the only way to let it do its job? Keeping those sudden emotional impulses completely in check. Moving to Section 2, maximize the free money. So, here is the absolute most crucial question for any young professional. Are you leaving free money on the table? Seriously, the single most important thing you can do the second you start a new job is figure out if you're taking full advantage of the employer match. If your company offers to match a portion of your retirement savings, or if you get an annual bonus and you aren't optimizing where that goes, you are literally handing part of your own compensation right back to your boss. No way around it. Let's actually put a number on that. According to Vanguard's massive 2026 How America Saves report, the average promised employer match is 4.7% of your pay. Just think about that for a second. That is an immediate guaranteed return on your investment before the stock market even opens. It's quite literally free money just sitting there waiting to be claimed. And it's an absolutely critical engine for building up your assets early in your career. Now, match formulas can definitely vary. Vanguard actually administers over 100 different ones. But the most common one you'll probably run into is 50 cents on the dollar up to 6% of your pay. So what does that actually mean for you in practice? Well, it means you have to contribute at least 6% of your own paycheck to capture that maximum 3% matching benefit from your employer. The rule here is simple. Always know your formula and always contribute the bare minimum required to get every single cent of that match. Section 3. The power of autopilot. Vanguard's data highlights the overwhelming success of what they call autopilot plan designs. Historically, you actually had to actively decide to opt into a retirement plan. It was a whole process. Now, many employers just automatically enroll you. They've completely reframed the savings decision. The underlying message is basically, hey, quit the plan if you'd like. By making the default action just doing nothing, you're automatically participating, your money gets invested, and crucially, your contribution rates can be set to systematically bump up a little bit each year. And by the way, this is the perfect mechanism for windfalls. Think about birthday cash, tax refunds, or those work bonuses. Set up your accounts so that extra money is automatically swept right into your investments before you even have a chance to blow it on material things you probably don't even need. Just look at how these median deferral rates climb over time. When people first start a job, say 0 to 1 year in, the median savings rate might sit around 5%. But as you track out to the 4 to 6 year mark and then the 10+ year mark, those savings rates march steadily upward toward 8 or 9% and beyond. It's amazing. By just doing nothing and letting autopilot work, your tenure at the company and those tiny automated annual increases combine to massively compound your account balance over time. And the best part, you don't have to make a stressful financial decision every single month. It just happens. Section 4. Embrace low-cost indexing. Okay, so you're saving money. Where does it actually go? The modern, highly effective solution offered by about 69% of Vanguard plans is something called an index core. Look, rather than trying to pick individual winning stocks, which, let's be honest, is incredibly difficult even for Wall Street pros, an index core gives you a comprehensive package of low-cost passive ETFs and funds that span the entire global market. We're talking U.S. stocks, international stocks, U.S. bonds, cash, the whole shebang. It gives you instant, broad diversification and completely takes the guesswork out of building a portfolio. And a real secret weapon of the index core? Cost. Keeping your investment expenses as low as possible is absolutely essential. Vanguard recently emphasized their ongoing commitment to lowering expense ratios across their mutual funds and ETFs. And why does this matter so much? Because every single fraction of a percent that you pay in fees is money that isn't compounding for your future self. A 1% fee might sound like peanuts today, but over 30 years, it can literally eat up a massive chunk of your total returns. Keeping that money invested, instead, mathematically guarantees dramatically better long-term outcomes. Which brings us to Section 5, Discipline over Impulse. The historical data perfectly maps out the whole story of panic versus patience. Tracking the S&P 500 index prices against intraday volatility spikes all the way from 1980 to 2025, you can clearly see some massive, scary spikes. Black Monday in the 80s, the dot-com crash, the global financial crisis, the COVID pandemic. Those are the exact moments when your impulse is screaming at you to sell everything and run. But if you look at the big picture behind all those jagged spikes, the long-term trend of the market has been overwhelmingly, undeniably upward. This is exactly why the Wells Fargo Mid-Year Outlook specifically titles its strategy Keeping Discipline in Noisy Markets. They advise that instead of scaring back your stock exposure every time there's a scary headline or a market pullback, disciplined investors need to view volatility as a completely normal, expected part of the investing cycle. It is not a signal to panic, guys. It's a reason to just stick to the plan you've already put on autopilot. So let's bring this all together into your ultimate playbook. Number 1, let time work for you. You got to start right now. Number 2, capture the full employer match. Never, ever leave free money on the table. Number 3, automate your contributions. Let autopilot save you from your own procrastination. Number 4, invest in low-cost index scores for cheap, broad diversification. And number 5, ignore the daily market noise. Volatility is just part of the ride. Honestly, automating all of this ensures your future is completely secure, which, and this is the best part, ultimately frees you up to spend your money guilt-free today. You can focus on memorable experiences, traveling, enjoying life, rather than just stressing out or accumulating more material things. The institutional data from Vanguard, Wells Fargo, and JP Morgan all point to the exact same conclusion. Simplicity and discipline win the long game, every single time. Your future self is depending entirely on the financial habits you choose to build right now. So looking at this playbook, what's the very first step you're going to take today to secure your financial future? Thanks so much for watching this explainer, and happy investing.